This undictated podcast is brought to you by Futuregrowth Asset Management. Today we're speaking to Michael van Rensburg, who is a portfolio manager with Futuregrowth Asset Management. And Futuregrowth manages a range of fixed interest funds for Old Mutual. And Michael's going to be talking to us today around 5 of the different fixed interest funds and telling us how investors would use them from a portfolio perspective, or whether they're looking for yield. We're going to be looking at the risks, we're going to be looking at duration and some of the underlying investments in those portfolios. Michael, I wonder if you can start off by just talking briefly around the 5 portfolios.
Good afternoon. Thank you, Candice. I'll start off by just giving you sort of the names of the 5 portfolios that we're looking at. First of all, and I'll also go up as we're looking in terms of the risk spectrum. The least risky of the portfolios are the Old Mutual Money Market Fund. Then we're looking at the Old Mutual Interest Plus Fund. That's a relatively new fund. It's probably about 2.5 years in the running now. The Old Mutual Income Fund, Old Mutual Enhanced Income Fund, and then we also look at the one that we classify as the most risky one on the risk spectrum, being the Old Mutual Bond Fund. So to start off with, let's just spend a bit of time with the money market fund. The money market fund, it's really for the moms and pops out there in the street, people that have got some savings and not necessarily want to put it into the bank, because there's some other advantages that a fund like that gives you over a bank deposit. So if I just touch on some of those advantages, definitely you're looking at diversification. Money market fund is invested in a diverse range of instruments, more so than what an individual in the street can actually get access to. So we're talking about individual securities, names like Barlow's, for instance, Anglo-American, investing in those debts, and then also having bank debt, which is across all the different banks, local and the locally domiciled foreign banks.
And Michael, is your capital guaranteed if you're in a money market fund?
We would like to think that it is. It's not guaranteed. I think guaranteed is using to a stronger statement. There's no guarantee as such. Very similar to what you get if you invest your money with a bank. A bank is also not guaranteeing your money, but there's a high level of security that you will get your money back. And also in the money market fund, we're looking at pricing as if you are going to get your R1 back that you've invested in. That's what we call it, the NAV evaluation, and it's a crude methodology pricing. So that means that the interest rate that you are earning every month, it pays interest out, and the interest accrues over the period.
Okay, so why would I move away from a money market fund then into one of the other 4 funds in your range?
Yeah, it is all about risk. Let's assume you've already taken the decision that you are having a part of your investments in fixed income as an asset class. Then it's definitely about the amount of risk that you want to take, your risk profile, and then also around the timing that you have. If you have taken a certain percentage of your portfolio that you say, I'm always going to have this in a fixed income range, then definitely you want to move up on the credit, on the risk spectrum. So it is about asset allocation.
So if I'm taking on more risk, can I expect more return from these portfolios?
Yes, certainly, and you should be rewarded. That's an old adage in our market: more risk, more return. And there are going to be, over time, you're certainly going to be rewarded for taking on that risk. There are going to be times in between where you'll find that one year, the income fund, and this is specifically what's happened now over the last year, the income fund gave you a return of 5.3 compared to what a money market, which is less risky, has given you a return of 5.8. So, and that has got to do with the valuation of it, but also interest rates have moved higher. And as you go down from the income fund to the bond fund, we were talking in our market, we're talking about a mark-to-market effect. So every day, all the assets are being repriced as if you can sell it that evening. So the seller's price is being used in, and that will then result into some sort of capital profit or loss over and above the interest that you've earned. Yeah.
Okay, so if I'm wanting to go into, for example, your Old Mutual Enhanced Income Fund, I actually need to have a slightly longer time horizon, because I'm taking on a little bit more volatility for a bit more upside.
Yes, absolutely. Because that particular fund gives you a lot more exposure to a lot more different asset classes. That it can, for instance, in that fund, we can also get exposure to property, the listed property, not the actual property building itself. So as you can see, those sort of additional exposures that the fund can take is adding more risk to it, but you are getting rewarded if you can just think of what the property as an asset class have given you over the last year. That's paid off very handsomely there.
So if I want to look at the type of risk that I'm taking on, is the benchmark a good indication of where I can see that?
That's a good starting point. I won't say that is necessarily the ultimate answer, because the money market you're talking about a Steffi composite, which give you across the money market curve from money on call all the way to a 12-month NCD. Now, if you stick to the enhanced income fund, the benchmark there is taking the call at and times it by 110%. So. Call at the moment is your worst asset class, so you don't have to do a lot to actually outperform the benchmark in this case.
Okay.
But benchmark is not everything, and we don't like to think that we're certainly not benchmark huggers.
So how would an investor who, for example, wanted to use one of these fixed interest funds that you've spoken about, how would they use it within their portfolio? I see that all of them are Regulation 28 compliant, which means that they can be used in pension funds. How would you recommend that somebody thinks about this asset class in the broader context?
Yeah, I would certainly, the first decision I would make is to say, I sit with my portfolio and let's say I'm looking at a stable monthly income of whatever, say 10-20%, and I think that is a decision that the investor has to make. And that portion, let's assume it's 10%, and he wants to keep the rest, the 90% in equities. That 10% then will be divided up among, I would say, 3 or 4 of these funds. Certainly, a portion has to be in the money market fund. That gives you a monthly income, but it is you can get your money within a week or 3 days. So it is really, if that's your emergency kind of money. Thereafter, the easiest would be to take a spread. If you don't necessarily want to take a full-on risk in terms of just investing everything into the bond fund. But keep in mind, the bond fund is taking on a lot of bonds. That's what the fund is. It's a bond fund, and there are a capital risk attached to the underlying instrument, and that is what the investor should actually look at.
So if, for example, an investor was looking for somewhere to put their tax-free savings account, National Treasury's new initiative, would you say that potentially looking at the Old Mutual bond fund is one of the places to invest that money because it's possibly going to be a longer-term investment? Absolutely.
Yeah, over time, the bond fund has given you a very good real return, not as much as what the equity would give you. There are some years where it outperforms the equity market, obviously. But the bond fund, I would certainly highly recommend that for an investment, for using that vehicle.
And for the same reasons, probably not investing in the money market fund for the very long term.
Yes, absolutely. You should see your money market fund as where you put your emergency money that you need. We're in a unique situation right now where the money market is actually giving you a positive real yield. I can't say it's going to kind of carry on, but that is what it is at the moment. But I always see your money market is for your emergency money. Yeah.
Thank you so much for your sage input. That's Michael van Rensburg, Portfolio Manager at Futuregrowth Asset Management. This undictated podcast is brought to you by Futuregrowth Asset